The economy seems to be in a rather precarious situation as of lately. The latest data is the economy grew 1.1% in the first quarter, and when comparing that against previous quarters, it is a pretty dramatic slowdown. Spending did slow as the quarter progressed, and forecasters warned that it could weaken further amid headlines about layoffs, bank failures. First Republic Bank is the poster child of this banking crisis. It does seem to be, at the moment, mostly contained with this bank as well as the previous failure of Silicon Valley Bank. But the shares of First Republic Bank continue to fall pretty dramatically after the earnings call showed that the deposits being withdrawn were even greater than originally thought. Companies are continuing to enact more layoffs as well. The overall unemployment rate is still at a healthy level. That's not having a major spike across the entire economy, but we do see layoffs happening seemingly every day. Now, we did need the economy to cool off because of the high rates of inflation, and it does seem like inflation is indeed coming under control with all of this slowing down the economy. The latest reading is 5%, still well above the 2% target, but if you look at the trend line, it's coming down very nicely, and it really does seem like we turned the corner, and instead of focusing so much on inflation, now we're talking more about the recession, because of course, to fight inflation, the economy needs to slow down, but you don't want to overdo it and cause a bigger than needed recession. And that's really the big fear right now of a hard landing. Articles like this say the US in worst of both worlds with high inflation, GDP slowing down. That's a stagflation kind of environment, something we do not want to experience. Now, it's not all negative. Lots of companies recently had their Q1 earnings call, and companies like Microsoft, Google actually came in above expectations. So for Microsoft, the earnings was $2.45 per share versus the $2.23 per share expected by analysts. And the revenue, in a pretty similar way, came in at $52.86 billion versus the expected $51.02 billion. And I love these diagrams. This takes information like the income statement and puts it into a visual format. So for a company that's as massive and complex as Microsoft, we can, in a more clear way, see exactly how the company makes money, all of their different divisions, where the company is raking in the most revenue, as well as things like operating expenses, cost of revenue, net profit, and so on. And for Microsoft, at a glance here, we can see that personal computing, so selling actual devices, is down year over year, but the cloud business is more than making up for that recently. Yeah, so even though the economy is factually slowing down right now by design, thanks to the Fed trying to fight inflation, it does seem like at least large companies like Microsoft, Apple, Google, they're continuing to operate just fine, and they're actually using this opportunity to become more efficient. Laying off excess employees is helping the company retain more revenue and become more profitable. So personally, I think the US economy is fine. If anything, this point of contraction long term should be a healthy thing for businesses. But one way to hedge against a slowing US economy is to invest in international equities such as ticker VXUS. This ETF seeks to track the performance of the FTSE Global All Cap ex-US index, which measures the investment return of stocks issued by companies located outside the United States. Now, historically, putting this against the S&P 500, historically, recent history, the United States has one of the strongest economies. But with all the concerns of a recession and a hard landing in the US economy, it could make sense to diversify in international stocks right now. As you can see here that year to date, international has done just as well as the US market. Now, VXUS is not the only way to invest internationally. It's potentially one of the best ways because it's a broad market fund, similar to something like VTI here in the States. But I know a lot of you guys watching this channel are dividend and income investors, and you don't have to forfeit that strategy in order to give you international exposure. So for example, if you guys follow the channel, you know that DIVO is one of my favorite income-focused ETFs. It invests in US high-quality dividend-paying companies, and they employ a covered call strategy overlaying that. But just recently, this same company came out with ticker IDVO, which is a very similar, almost identical product, but focusing on international equities. So if you click into it, the objective and strategy here is as following. IDVO is an ETF of high quality, international large and mid-cap companies through American Depository Receipts, or ADRs, with a history of dividends and earnings growth, along with a tactical covered call strategy on individual securities. Here's a list of the top 10 holdings, and these are very different than what you see in DIVO because they're all international companies, but some of these names are definitely recognizable, like ASML. And when it comes to country allocation, the United Kingdom is the most represented at 17%, followed by Mexico, Taiwan, India, Switzerland, and so on. Now, this fund is extremely new. The inception date was early September of 2022. Since then, the price has trended mostly sideways, but it is up a little bit. The dividend data isn't complete due to the young age of the fund, less than 1 year old, but the current payout per share is about 13 cents. This is paid out on a monthly basis, just like DIVO, and if we extrapolate this out over 12 months, that's an annual payout per share of about $1.56 on a share price currently of about $26.50. And if we stack up the performance of IDVO against DIVO side by side, let's get rid of the S&P 500 and include the dividend. So let's go to total return. We can actually see that over this time, the international version has outperformed. Now, this could be a result of a magnitude of different reasons. Maybe the recession in the United States is beginning to affect things. Personally, I don't think that's the culprit because other names like VGT have done really great here domestically since the beginning of 2023. Yeah, so VGT is up 20%, DIVO essentially flat, and IDVO is up almost 6%. Now, when it comes to my portfolio, I have been considering adding international exposure to a small degree. Of course, you can do this in many different ways. I could just add a 10% allocation to VX US, or I could try out this ETF. I'm just not fully convinced yet because I have a strongly held personal belief that the United States will continue to be one of the best centers for economic growth globally. As we saw all last year, investing in Chinese stocks can be extremely volatile, and other developed markets like the EU just tend to be more stagnant in their growth, and they usually underperform the US market anyway. But let me know your thoughts in the comments and what portion of your portfolio, if any, is currently invested in international stocks. If you guys enjoyed, I appreciate a like, subscribe, and I'll see you guys in the next one.